Hello, everyone. Welcome to today's session. We'll jump right into it here and talk a little bit about market conditions. Let's jump over to directional alerts to start out with. We've got just a lot of extreme volatility here the last few days happening. Some pretty nasty sell-off, a decent little rally going on here today. We've got momentum, which has pushed its way all the way to the extreme side here, which is essentially we're just at the bottom end of a range. Whether or not this is a significant bottom, a support area, and we get a bounce and continue higher, or whether we get a counter trend back up and then ultimately start a deeper retracement down, that's kind of yet to be determined, obviously. But those are the two scenarios now at this point where we can start to be watching for some support to happen here. And then in terms of pattern, I'll talk about this in just a little bit, but we want to be watching for the resistance area to be hit, here, and then a retracement, and then a pullback, some support once again if we're looking for more upside or some downside. I'll pull in that pattern here in just a minute, but watching for, we're getting a bounce here today on some decent job news apparently, and markets are still there's still not enough fear in there to spook off all of the FOMO, but almost. And that's kind of what we want to see for a good solid rally, is for some to not think that it's going to rally. When everyone thinks it's going to rally, that's typically when it doesn't happen. Just like when everyone thinks it's topping out, it's typically when it doesn't either. Okay, so let's take a look. Sentiment, we've been slipping here a little bit, and this actually was pretty healthy. We've kind of wanted to see a little bit of a move like this for a retracement back to just a little bit of a spook. When you get that in the markets, that starts to play with everyone's minds, and that creates a little bit more of a truer market perspective of people actually start digging into their stocks, and they start looking at, hey, maybe Nvidia is not the savior of the world. There's a million scenarios. This happens all the time in the last 20 years, 25 years. It's always the same. It's always the same theme, but just different players. Oftentimes, whether it's right now, it's Nvidia and it's chip stocks, and it's all of those, anything to do with microprocessors and storage and data centers for AI. And that definitely is going to be a very long-term trend. But as we've talked about often, markets overshoot to the upside and they overshoot to the downside, just because the market participants are we are greedy and fearful creatures, and so we want the best of everything, and we want to make sure we're staying out of the worst of things, and that creates market volatility. And oftentimes it is healthy, because it sometimes allows you to question if you've got the right decision or the right trade or the right direction, and that creates a little truer perspective of the current market environment. Okay, ultimately it's earnings of a company, ultimately it's their pipeline, ultimately it's the what are the long-term perspective of those earnings and profit margins. That ultimately is what a stock is trying to determine. What's the true value of this company? And the value is going to increase if they are growing and they're profitable and they're increasing. And we want, the market participants are going to push those stocks higher. And when the froth of the excitement and all the headlines and everything, when that kind of goes away and the rubber meets the road when it comes to actual fundamentals, and they're not there, then companies get beat up. And that's kind of what we're seeing here. We just had a pretty decent sell-off here based on kind of an eye-opening scenario to say, this may or may not be as everyone anticipated, but it's not going to be. We've been through these cycles before. It's the monetary part of the cycle, and then whether or not the recession is going to happen or not, those are really ultimately at the core of what's going to be driving the market here. We've got a buy-sell ratio, which is still pretty bearish, 0.25. We're pretty wide right here, and so watching for, when we get these moves, as I've mentioned before, when we get that first spike, it usually is not the last one. Okay, we usually get this. Some of the formations are a little bit choppy. even back here. This was one that maybe was a little bit more of a head fake, but usually when you get that strong move, either bearish or bullish, that first move is typically not the end of the move to go straight back up and straight back down. Typically it's up, and then you get a couple, either a couple of little turns back here as they're working themselves back together again. So I wouldn't be a bit surprised to be seeing a rally higher, some retracement, a retest, and then watch to see how this is in another couple of weeks. We'll look at that pattern here, and I'll explain that just a little bit more detail. We definitely are in that oversold range. This is the sentiment on market on S&P 500. So we've been oversold. When you squeeze that in and look at the last 5 years and look to see where are we at in relation to all of these other bottoms in the last 5 years. So this is even going back to 2019, and you can see how deep that retracement has been, and it was pretty fast too. So that can mean a couple of things. Number one, it means that we're deeply oversold. It almost has always bounced from these levels. The question is, are we going to get this kind of a bounce all the way back up again, or more of a bearish bounce where we rally up to these levels, retest it, rally up, retest it, and we get more downside? What this doesn't show is it doesn't show the trend. It just shows the magnitude of these moves. So from here, a rally back up again, and then whether we retest back down or not is will yet to be determined. But we're at an area where we could certainly see a rally, either short term or long term, right here. Okay, time's going to tell. NASDAQ 100, or I should just say just the NASDAQ. Let's point in the 5 years here. Let's just go to there's the 5 year on NASDAQ as well. So again, it's pretty significant area, pretty significant low if we look at how far this has been. Just in the, this is 5 years. And so we've got a pretty significant sell-off right here. It feels really, really toppy right here. And so we'll be watching. I would anticipate more of that. And why would I anticipate more of that? Because of the context of the trend, right? Where are we at in the real long-term trend? We're at the very top of that long-term trend. This chart right here is 20 years of the S&P 500. So we've had this move really for the last 2 years, essentially. And in the last 20 years, we're right at the top. This move right here, this was COVID. Okay, so just to put a little context in where we've been at since COVID, we had that sell-off, the rally, bit of a bear market. We've been rallying ever since. So watching to see an aggressive sell-off early on in this topping location is the bias that we need to start to look at, because the chances of this curling over and going even higher, we certainly could get another push higher, but it just is getting very tired. And we still have this long-term issue. Remember, don't forget about this. This has got to be corrected, this bond yield curve. And that is a part of what's happening recently. We're seeing the yields start to jump around a little bit, but this is also a really long-term chart going back to 1993. So this isn't, even these moves that we've seen recently, it hardly is budging these. And we need, the Fed's got to get going here and start to lower some of those interest rates, particularly if we're getting bad economic numbers, recessionary type numbers, slowdowns, layoffs, corporate earnings are slowing, and we're still kind of in the middle of those earnings, kind of get towards the end of that. But obviously we know what the market is saying, and the market is saying we're going into recession, or potentially already are in recession, and the Fed's got to start cutting. And that's, again, it's just a different year, but the theme and the broken record sometimes when it comes to the Fed is they just move too far. They typically will wait too long one direction or the other. So the fact that they are very consistent in being inconsistent should add some consistency, if that makes sense. That we know that they're probably too slow, which means the economy probably already is in recession, which means they're going to have to lower rates, and the market is going to, if we're in recession, the market's going to continue to retrace from these levels. Let's look at S&P 500. Here we've got this pattern. This 6-month pattern is starting to get a little bit messy. Let me get rid of the volume off of there, because what I'm talking about in that retracement, we're still on the 6-month time frame. We're still in this overall uptrend. Okay, so this is grabbing, this Fibonacci tool is just grabbing the highest and lowest points on the chart. If the highest point of the chart is over here and the lowest part of the chart is over here, then they're going to connect this direction, and that's the bearish trend. Okay, right now they're connecting to this high and to this low, so we're considering this still the trend, which means all of our Fibonacci levels here become support and resistance levels. Okay, think of them as, you know, a staircase, stair stepping. It is now we've broken through this first one, we've broken through the second one, we've broken through the third and the fourth one, and now we're in that corrective zone. We've just sliced right through all of this, but inside of this box right here is now the location where reversals typically happen. Okay, and we weren't too far off on S&P 500 to get some kind of a bounce or some kind of a bottom. And the question is going to be now whether or not this last couple of days of volatility, if we can start to hold levels again. Okay, that's what's going to be starting to be important, is even back here. Okay, so we're holding levels. So we've now held the 618 on S&P 500. Now the question is, can we hold the 50% level? Meaning it closes above that level and then we get some support, and then any pullbacks to that level, we get buying and it adds into that support, and then we run up and we hit resistance here, and then we retrace, and then we get some support there, and then we break through this. Okay, that's kind of what we want to start seeing. What we don't want to see is, we want to see, at least for a more continued uptrend, what we don't want to see is additional resistance. This was looking pretty bearish yesterday. We have this tail bar and this massive reversal, and so we'll see. We've still got a couple hours. We had a couple hours yesterday too where it just faded. Faded is where about this time of day when the markets are up, and then they just gradually kind of fade. They just kind of gradually fizzle out because you get selling. Anytime you're seeing rallies and opportunities for investors and traders to get out again, to sell positions that they've already got, then it fades and continues to move to that downside. That's kind of where we're at right here. So in terms of bias, we're just watching to see whether this is counter trend, reversal, watch for support levels, and then that next support level. These are going to be, a little bit quieter times in terms of, we got stopped out of a lot of positions. So now it's about adding into additional positions, but keeping position size, within our acceptable framework of around that 2 to 2.5%. Most of the allocations that I'm working on right now are 2% or less. So some of the most recent trades have been 1.5%, or something like that. Typically no less than that, but just depends on the stock and the pattern and the number of shares that we can get, and maybe the day, the current market conditions as far as that. But 1.5% to 2% right now is about the allocation, just because of this trend. Okay, even great stocks, as I've mentioned before, all stocks are bad. Okay, there's no such thing as a good stock. There's no such thing as a safe stock. Okay, they can all drop and they can all be volatile. It doesn't matter if they pay a dividend. It doesn't matter if they're Apple or Google or Meta or Amazon, and make billions of dollars a year. Every single stock can knock the wind out of you. So think of it that way. Think of that. There's no such thing. Although you're going to hear that all the time. Oh, you need dividend payer stocks and all of these things throughout bear markets. Yes, that can certainly help for different strategies, but those stocks can still drop 20, 30, 40%. So holding on to a 30 or 40% loser just to get paid a 5% annual dividend doesn't make any sense to me. So at least for a trading methodology, maybe for a real long-term type of methodology, that might make sense. But if a stock is going down, I want nothing to do with it. Okay, there's no point in it. No point in holding on to it and just waiting it out and seeing how far it can fall, waiting for that support. Take a stop, get out, move on. Wait for some of those positions to start to recover again. Case in point, NVIDIA. Let's talk about some of these names right here, because NVIDIA, it's going through the same story as the S&P 500, and that is potential bottoming out right here. Okay, and if this rally today, it's up 6% right now. If this rally can continue to hold this level, then you have another support range, and then you even potentially have as a bottom fishing trader or a reversal type trader, where you're looking at these counter trend moves and then ultimately expecting more upside. We're inside of that corrective zone right here, okay, but that's a little bit early. It's still going to be red, which means that it could rally all the way up to potentially here and then drop back down again. Okay, so the reward to risk is I may be able to take a trade at these levels and get to here, and then maybe it retraces and I'm stopped. I got a stop loss here, and then it continues to move higher, and I'm in that trade a little bit earlier. It gets us in a little bit earlier. We can manage it the exact same way. We can say, I'm going to buy this stock right here. I would say if I'm going into a trade and I'm going to have a $100,000 account, let's say 20 shares. So at 20 shares, I'm at 2%. And if on this one, if I were to put a stop loss all the way down below these lows, let's just call this $94. And I said $94 is my stop price. Okay, that puts us with a 0.21 at risk, and it's about a 10% stop. That's a trade you could take, okay, because you now know what your risk is defined. Your anticipation, your strategy is that it's a counter trend or reversal or a bounce or a dip buy. Okay, it's typically not it's not obviously not the momentum strategy that we want to utilize the most consistently, but there are opportunities to get in on pullbacks, and there are also ways to be able to do that in a way that is still inside of this structure, this money management structure that we want to continually focus on, and that is what percentage of my portfolio is at risk, what percentage of the trade is at risk, how big is my transaction size or my position size, and then you're doing the money management part of it is the same every single time as well. The patterns might be slightly different and the strategy might be slightly different for entry, but it's one of the ways to be able to enter into a bottoming stock. And potentially, if there is already a low in place, that gives you a location to get stopped out if you're wrong. If it retraces back down and we got stopped out at 94, okay, we're out 10% of that trade, or $200. So we have our risk defined, and that's half the battle for most traders to jump in and say, should I buy Nvidia right here? I don't know if it's going to go up. I don't know if it's going to go down. I don't know if it's a good time to buy. I don't know if this is the right price. Or okay, that this can help alleviate some of that, because really you can buy a stock at any time, at any price at any time, and still utilize this money management approach. And that's going to add the risk management factor into a little earlier attempt on an entry. Okay, so these kind of stocks, Nvidia, I'm not saying that this is going to continue to go up from here, but it's got a pretty decent 2-year retracement now, pulling all the way back. So this 2-year time frame goes all the way back to this November of 2022 low, and we've retraced to the 382. So it's a pretty decent retracement for that real long-term trend. On the 1-year time frame, we're about at that 50% zone. Okay, so of this entire real mega rally that Nvidia has had, we've retraced just about half of it. Okay, and we've also gotten back to these support levels. So this actually could be a pretty significant low for Nvidia right here, particularly if we get that bottoming pattern where we get a new low like this. Okay, we get that new low, there's some support here, we can set a stop at this low, or we can wait, say here, let's wait for this to go up, let's wait for it to clear back up, let's wait for it to look more like this. Okay, that's going to be more of the momentum strategy, is to wait. And the reason why you would want to wait is because it just gives you more confirmation. Okay, sometimes people have a hard time with that, saying, well, if I would buy here, why on earth wouldn't I buy back here? Well, it's because we don't have 20/20 hindsight, right? Or I should say we do have 20/20 hindsight, but not in the moment. We don't know exactly how this is going to unfold. It could roll back down, and so I may want to wait for the green, for the confirmation. At that point, then I have a really solid base to be able to utilize as my stop loss. There's a lot of buying and selling that's happening right there, and so you're getting the momentum shifting. Okay, and that's what we want to do, is we want to try and get in front of the bulk of the momentum but we want to wait for some momentum to present itself. The momentum has yet to present itself to the upside. The momentum is still to the downside, and that just adds a little bit more risk. But again, with the additional risk of it, being lower, what was our risk? 10%, $200. We know our exact risk. So if we wanted to take a stab at trying to pick something on the bottom, then you could do that, and you at least know that your risk is defined, or wait a little bit for it to move back up. It's interesting on stocks like this because sometimes when they have these big runs, and depending on the time frame, and you get these really huge runs, there are times where this is it. That's it. That's the rally, and competition comes in. I've heard of other companies now that are going to start producing GPUs. You're going to get massive companies that start want to compete with NVIDIA. They're going to get more competition, which means they're going to get less revenue, which means their stock price may not grow as long. That's not the case yet. They're still making a boatload of money, and we've talked about the relative pricing utilizing a PE ratio. This PE ratio at 59 right here. If we go back and say, what did the PE ratio look like at the bottom back here when the stock was $16? The PE ratio was 57. If you look right over here on this box as I'm mousing over that, 57. Well, what's the PE at today? It's at 57, 59. Okay, so the PE ratio at 100 is the same as it was at 20. Okay, that's why the stock price can continue to go higher, because it's earning profits. It's making a lot of money, and the stock price is justified. So the question is the market going to say, yep, it's justified? It was justified at 59 here. It's justified at 59 here to push to these upper levels of 80. So that upper level was the PE of 80. PEs are hard to manage, but they work well for that kind of analysis that I just explained, and that is if a PE ratio is 50 on NVIDIA and the market participants were able to say that's a fair value to push it higher, now is it still a fair value based on everything that's been happening? Can it continue to grow at the growth rate that it has been? That's why technical analysis, or this price activity and following these trends, is equally, if not more valuable, because this gives us the mass consensus of this analysis. If large market participants are saying, yep, whatever, this number we're buying because of this, or 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 this, or this, or whatever the case may be, then we jump on board with that, with the mass consensus. Okay, and so the mass consensus right now is something's broken in this process, in this pattern, and let's wait it out. Let's stop out. Okay, we would have been stopped out somewhere up here on this trade. In fact, we traded it in the portfolio. We bought it here, we sold some here, we sold some here, and then I think we were stopped out either on this move or on this move. Okay, so now it's just the waiting for, we can wait for another move higher and let the dust settle a little bit here as well. So that's NVIDIA. A lot of stocks are still in that move. The NASDAQ 100 has really gotten hit hard, and it's also a very similar location, up 3%. A pullback on that, that's the 2-year time frame. That 1-year time frame is right around that 50% range, just like NVIDIA. And so tech names actually may be a place to start watching for some support to start to happen again, or at least watch for the retest to see if we do get a continuation higher and then some support back in. There's going to be resistance again. We've got lots of resistance now, lots of resistance before we get back into momentum to the upside. We're not there yet. We don't necessarily want to fight that on some of these names, but we do want to enter into trades that are still in momentum or entering into momentum. So when we're looking at new trades, even in a downtrend, we can go in and we can look at new buys, and we can go through this list and say, okay, here's Axon, which is in the law enforcement safety protection. They produce taser guns and things like that, to where it's obviously right now must have had a big earnings, big gap higher, continuing to work higher. We can go through and look for some of these stocks that may be fitting some criteria that we may want to consider. Axon's just the first on the list. AQST, a little bit deeper in the retracement. I wouldn't want that one. RYM, this would be one I'd be more interested in now that it is in this upper momentum zone. Okay, so even in downtrends, we're seeing some stocks that are still leading and working. And there may be rotation out of what stocks were leading the last time during the last run up, and which stocks may be leading in this next rally, or which stocks are going to continue to work even if the market is just continuing to move to the downside. It becomes harder and harder for stocks to hold up as the markets are dropping, but that's why our position sizes and our portfolio size is relatively small right here. Okay, so we're still just a small number of stocks. We've been adding into those. We got stopped out of a few. We're now adding back into those as the market allows. We've got a big lump of cash, and as long as these stocks continue to work, some of the other ones that we got stopped out of may or may not show back up again, back into these upper ranges. Okay, so the portfolio allocation on the position size is, naturally, what are we at now? We're at about 15%, maybe 20. Yeah, it's probably about 10 to 15% allocation, and the rest is sitting in cash, happily sitting right there in cash. Happy as a clam, right? There's no volatility in that cash world. Let's just wait that out, let the markets do what they're going to do, and we'll participate in those markets with the percentage that the market allows, and that is whether or not we continue to get stocks that continue to move to the upside or whether we get stopped out. It's kind of a fun practice also to go through, a lot of times when there are a lot of new names in that new buy list, and that's one of the things you can do is just on this drop down here, you go to muscle scans, and then you've got all your scans here, these scans that are up on this list. Each of these tabs, if you go to the chart, they show up here as well. And so then you can just kind of quickly scan through them and look to see which ones may have interesting patterns. So that was a pretty nice move. It's interesting too, when you see an stock with big earnings and then massive volume, a lot of times you do get a follow through day. I have a hard time buying into those because there's not a natural stop loss location, because some of them can drop all the way back down again. And if it's a pretty wide gap, then those are a little bit tougher to trade. But the fact that you get a lot of volume is telling you something. There's big demand for a big stock breakout like that. And then going through, I saw one here as well. U.S. Steel. We have a steel stock in the portfolio currently, which is ASTL, and it's been retracing. I don't think that's a real data point. I went in and looked at that intraday, and it was like just on a 1 minute chart, it was like 1,000 shares. So it could be, but I don't think it was. So it's kind of holding in that support range. We're seeing steel see some strength. We get some confirmation on some of these additional names as well. U.S. Steel, although U.S. Steel is a little bit deeper retracement. Louisiana Pacific, which is a wood product for construction. If we see interest rates come back down and we see home building start to improve, we may see some more higher demand for wood products. That's kind of in that same realm, that construction realm that's been doing quite well. And you can look for opportunities that look just like this. This is the area we want to be looking for, as a stock that's up here, giving us a new buy signal, increased volume, open, buying at the next open on the next day, setting a stop loss around 10% or below those most recent hold signals, and away we go. Okay, that's our setup for those trades. So interesting market conditions. Stay safe. Don't get overly excited about putting money to work right here, because it's a sketchy time right here, particularly because of these two factors, because of everything we've talked about, right? There's going to be lots of opportunity, but the economy still has to be functioning properly for money and capital to be allocated to where it needs to go the most efficiently. And we're seeing that the market, for whatever reason, is at least just correcting that. Right now, it's still just retracement. It's not full on reversal or bear market. We're not even close to that, but this is how it starts. Okay, it starts like this. It feels like, is this a correction? Oh, is this a retracement? Oh, nope, it's not. There it goes. Okay, and things start to slide, and then ultimately we end up with one of these, or one of these, or one of these. This is going back to 2010, or even going back to 07 and 03. It's just a part of the ride. It's just a part of the process, and we want to make sure that we're in position to profit based on our own suitability, so that we're not taking aggressive risk, so that we're doing it consistently and in a sound, systematic way, and we're not just gunslinging and throwing darts. And particularly on the risk management side, sometimes you can throw darts at stocks and be just fine, as long as your risk management is in place. As long as you know what your position size is, where your stop loss is, what your portfolio at risk is, in addition, as you have your stop loss set up as well. And then you can allocate towards that portfolio. You're building out a portfolio of stocks, and those individual stocks that you're looking at each day can be based on lots of different things. Right now, ideally, we're looking for stocks that are in those upper trends, have momentum to the upside, they're high ranked. Ideally, they're going from hold to a buy on increased volume, and then we're managing our risk from there. I'm going to end on that note. Everyone have a fantastic weekend, and we'll see you next time. Thanks a lot. Bye now.